My name is Jake, welcome to the channel. In today's video, we're going to do another Review My Pie video where I review subscriber portfolios. This is one of my favorite series here on the channel because I get to interact with so many different people and hear so many different perspectives on reaching financial independence through dividend investing. This week has been a really interesting week. I think if you would have asked me a year or two ago, hey, what was your highlight of this week? I would say, it was really cool to see the stock market down. When the stock market's down, that means I can get more value from my investment. When I read a headline like this, I think 2 years ago, it would have really got me excited. The Dow suffers the worst Black Friday sell-off since 1931. I'm sure a lot of people took advantage of this sell-off as a buying opportunity. I don't have a crystal ball. I don't know if this is going to continue, if the market is going to continue to sell off into next week or, throughout the rest of the year or whatever. What I think is interesting is my priorities in life have slightly shifted this year. For those of you that have been following the channel, you know that my wife and I just had a baby boy. I'm in my mid-30s. My wife is in her mid-30s. This is our first child. And so having a baby has really changed my mindset on how I view investing, but also what's really important to me. And so, yeah, seeing the market sell off on Friday was cool, but really what I'm going to remember from this week is our baby just started to crawl this week. Seeing him crawl on the floor for the very first time, that's what I'm going to remember. Seeing that this week our baby just started developing teeth in his mouth, that's what I'm going to remember. And when it comes to investing, it's not about getting the best deal. It's not about picking the best portfolio mix. It's not about that. What it's about is about financial independence. The reason why we invest is so that we can have freedom and so that we can choose what we do with our time. That's what it's all about. And with the holidays, spending more time with family and really reflecting on that, it really helps me to put my feet on the ground and understand why I'm doing this. Why am I here? Why am I investing? What am I doing with the portfolio? It's not so that I can be rich. It's not so that I can flex and, have the nicest things. It's so that I can buy my freedom, buy my time. That's what it's all about for me. Now that may be different for you, but I think the important thing is understanding your why. Why are you investing? Are you doing it so that you can buy that brand new Rolex? Or are you doing it so that you can reach a certain level where you no longer are required to work, or if something happens so that you're financially secure? In today's Review My Pie, we're going to review 4 portfolios. The first is going to be from a 22-year-old here in the US, the second a 31-year-old here in the US, then the third a 19-year-old from the US, and then the fourth a 53-year-old who's currently living in the United States but is from Germany. I will leave a timestamp in the description below to every single one of these portfolios, as well as the portfolio links in the description. And as always, everybody, I'm not a financial advisor, right? I'm just some random dude here on the internet. Don't take what I'm saying as financial advice. It's just merely for your entertainment. Speaking of entertainment, if you've been following the stock market here in 2021, and if you've been reading any headlines on CNBC or anything about the financial markets, it's been a roller coaster of a year. And being a new investor in 2021 probably felt a little like this.
Yalla. عيتني 3 4 يا عم هاني. يلا ايوه الاخيره يا عم هاني.
Oh my gosh. I think I've been able to avoid every single fad here in 2021 when it comes to investing into, cannabis stocks, investing into hyper growth stocks like Zillow or Peloton, who, ones that have dropped about 50 or 60%, pretty much like depression level drops. I think this year has been a really, really crazy year. The one thing that I haven't really been able to avoid is when I go to the store, seeing the prices of consumer goods soaring, right? And that reality of inflation, that's been pretty unavoidable for everyone. for the most part. All right, the first portfolio is from Josh. This is actually a portfolio that was sent in last year. I was going through my older emails, just wanted to make sure that I touched on every portfolio that was submitted via email. And it looks like this portfolio I actually overlooked. So I wanted to make sure that we got this portfolio. So this was a year ago. And so let's see what's been going on here in the last year. So Josh writes here, "Hi Jake, I'd like to submit my portfolio for the Review My Pie series. I am 22, just graduated at the start of summer 2020 with a chemistry degree. I've since found a $40,000 salary job, and I recently started investing in October. I contribute roughly $500 a month to my portfolio, and my end goal is to gain enough passive income through dividends to retire by the age of 45. Do you think this is possible in your professional opinion? I often listen to your videos while at work, so thank you for the entertainment. Please stay safe and happy holidays." Well, I mean, Josh, by no means am I a professional. I mean, I'm not, like, I don't have a CFA. I'm not, this isn't what I do for my day job, and I'm not certified. I just am a certified nerd when it comes to investing and learning about dividend investing. So I would say I'm a professional nerd. But I think when it comes to this, it really just comes down to your expenses. If you want to retire in a certain time frame, it really is top of line, bottom line. So what are you bringing in and what is going out, right? What are you spending? If you can reduce your expenses, I think most people, most normal, average, run-of-the-mill people can retire much earlier than they think if they can get their expenses in check. So that's really the key thing. When it comes to this, if you're 22, you have over a 22, 23 year time frame. That's a heck of a long time to let your portfolio compound. It really just comes down to getting the right growth rates in your portfolio to really let compound interest do the heavy lifting for your portfolio. So I don't know what your expenses are, so I can't really say yes or no if you're going to be able to retire off of this. But I would say as a blanket statement, yes, in most cases you could, but it really depends. Are you going to be able to retire in Silicon Valley, right? Or in New York? Maybe, maybe not. Are you going to be able to retire in the Midwest or a lower cost of living area? Yeah, very likely. So it really, those are the things that you have to make sure that you're being aware of and not just looking at the dollar amounts. Because at the end of the day, it all comes down to your expenses. All right, so let's take a look at your portfolio. I don't know why the chart here in M1 Finance is not working. This is really important to see the historical growth of the portfolio. Your dividend yield is just over 2%, so you're beating the S&P 500. You have a very low expense ratio, which is really, really good. You have 25 holdings. 25 is a good number if it's a manageable amount. Now, when you're looking at this, you really have to ask yourself, what is your approach going to be? Are you going to be a buy and hold investor, or are you going to buy and then look to sell in 25, 23 years and then transition the money from somewhere else? I think both approaches could work, but that's something that you definitely have to be aware of is what is your goal? What are you going to be doing? So, fast forward 23 years, what is the ideal situation? Do you want to have a large portfolio value that you're going to then sell, which you're then going to transition into maybe higher yielding dividend stocks? Or are you just going to slowly, brick by brick, build up this portfolio and let the compounding nature take effect? So that's really the first question of how you want to approach this. Are you going to buy and hold, or are you going to focus more on growth and then transition out of growth in 23 years into higher yielding dividend stocks? So let's first take a look at your structure of your weighting of your portfolio. 30% in technology, 20 in consumer. This is probably a mixture of staple and discretionary. Equities, maybe this is ETFs, I don't know. Healthcare, finance, real estate, telecommunications, and industrial. Let's look at your technology. Okay, technology, you got Apple, Microsoft, Qualcomm, and Cisco. I think this is okay, but I'm not the biggest fan of so much focus on so few companies. So let's take out this calculator here, for example. Let's say you got 40% times 30. That means 12% of your total portfolio is in one company. It's not something that I personally would do because you're putting so much emphasis that Apple is going to continue to maintain that pole position in the market, which no one knows what the market is going to look like in 20 years. Now, Apple, Microsoft, they're very competitive in terms of, they're very sticky. It's hard for other companies to come in and take market share from them. But just from an overall risk management perspective, I think holding more than 5% in an individual company is a little bit riskier than I personally would recommend. You could look at getting into an ETF, like a growth ETF that has the largest percentage in Apple and Microsoft. For example, my favorite growth ETF is VGT from Vanguard. I also like SPYG. So that's something that you can maybe check out. But I think this is you're overweighting in two companies, though they're great companies. I personally couldn't see myself doing that. But that's something that you could definitely consider. If you want to keep 30% in tech, maybe you add a growth technology ETF to this slice. Let's take a look at your consumer. You got Pepsi, Coca-Cola, Target, and Kroger. So a lot of these are staples in Coca-Cola, Pepsi, and Kroger. Target is actually considered a consumer discretionary. I think these are fine. I think for a 23-year-old time horizon, I would lower costs. I would lower Coca-Cola and increase Target. Maybe you could consider even looking at adding like a Costco, for example. I think having Pepsi at the highest is fine. This is one of my favorite consumer staples. It's really, really, really great. But I think you need a little bit more growth, even more than 75. Like 75% in 5 years is not enough growth, in my opinion, for a 23-year time horizon. I would look to see if you can get a little bit more growth. By getting more growth here, you're going to get a bit of a reduction in the current dividend yield, but that's okay because over a 23-year time horizon, you're going to be able to compound that, and it's going to work a lot harder for you in the long run. So I would look at getting a little bit more growth here in consumer. In your equities, these are your ETFs. Okay, you got VTI, VYM, and SCHD. These are all three wonderful, wonderful ETFs, really great ETFs. I own all of these. I own VTI in my Roth IRA. I own VYM and SCHD in my dividend portfolio. I think these are three really, really great ETFs. Like I said, very similar to the consumer staples. I think you can get a little bit better. A better return over the long term by looking at a few other growth ETFs like VGT or SPYG. Two really, really great growth ETFs. Healthcare, you got CVS, Johnson & Johnson, AbbVie, Pfizer. Yeah, I think these are fine. I would try to get a little bit more growth and get maybe a little bit of a smaller dividend. I think having AbbVie, I would swap out CVS and AbbVie personally. I would try to get this down to maybe a 2% and see if you can get this this total return, the share price value up higher over the next 23 years. I think these are great companies, but over the long term, I think you would be better suited for focusing more on growth. Let's take a look at your financials. You got Visa, JP Morgan, Bank of America. Yeah, I think these are fine. Two traditional banks. JP Morgan is really evolving in how they're, looking at the fintech space. Visa is really, really strong. I think these are fine. Let's take a look at your real estate. You got Store, Realty Income, and MPW. Yeah, these are really, really good. I think maybe take a look at a few other ones that are growing a little bit faster. Take a look at American Tower, ticker symbol AMT. Maybe take a look at Prologis, ticker symbol PLD. There's a few really, really great growth REITs out there that I think may be a little bit of a better fit for your time horizon. Telecom, you got Verizon and AT&T. Yeah, I mean, these are your traditional telecom companies. Maybe you could take a look at Comcast. Comcast may be a good one that you could look into in there. Industrials, Waste Management, and 3M. These are really good. A few others that I really like for growth. I like Caterpillar. I like Union Pacific. I like Honeywell. Those are really, really great industrials. I personally I think you could bump up industrials, man. Like industrials, this is a strong sector. You could look at, if you were to add maybe a few others or, consider them, that are a little bit more growth oriented. You could look at increase in industrials, and maybe you could lower maybe consumers a little bit. You could, like for me personally, with a 23-year time horizon, immediately I would lower telecom. Telecom would be the lowest in my opinion. Industrials, you would want to bump that up. Well, Josh, thank you so much for sending over your portfolio. I think you have a good manageable amount of holdings. Like I said, I would definitely take a look at the technology. I personally think you're a little bit overweight in a few of those companies. They're great companies. It's a little bit more risk than I personally would feel comfortable taking on. Industrials, I definitely think industrials you could bump up a little bit. And what I would recommend is really ask yourself, do you understand how these companies generate revenue? That's the key thing. You're adding number of 25 where I think you can really realistically do the research on these companies and make sure that you understand how they generate their revenue. But yeah, thank you so much for sending over your portfolio. The next portfolio is from Darius. He writes, "What's up, Jake? I hope everything is well in 2021. Out of the gate, I just want to say I appreciate your efforts of creating a channel that spreads the knowledge of investing to new investors like myself. My name is Darius. I'm 31 from DC. I'm a contractor here at the Department of State. I'm debt-free, and I'm proud to say I've been investing for about a year and a half. I have a taxable and a Roth IRA with M1 Finance. I want to live off of the passive income with a time horizon of about 25 to 30 years, so about the traditional retirement age. So you're looking to retire after 59 and a half-ish. Okay, good to know. Really important that you're maximizing those tax-efficient, tax-advantaged accounts like a Roth IRA. As of right now, my Roth is almost maxed out for the year. I currently invest about $1,000 a month. By the way, I would like to know your thoughts on the allocations of each sector. Thanks again for all that you do. You're the man. Here's my... Well, hey, Darius, thank you so much, man. I appreciate it. Congratulations on being debt-free. That is such an amazing feeling. So you got a few things here that I want to kind of look at. The very first thing is, if you're 31 and you know that you're going to retire after the age of 59 and a half, really focusing on those tax advantage accounts is really the best thing that you can do, right? Whether it be a 401k, whether it be an HSA, a Roth IRA, like that's where I would definitely start. So let's take a look at your Roth IRA first. You're up about 65% over the last 5 years. This does not count the reinvestment of dividends. You have a starting yield of just over 1.5%, a good healthy expense ratio, and you have only 7 holdings. And I like the fact that they're only in ETFs. This is very similar to what I do. Because my retirement accounts are really for the long term, I just like to set them up and forget them. And so I think you're taking a very similar approach. And I personally think it's just so much easier because you know that you're not going to be accessing this money for 20, 30 years. So you just set it up and forget it. So your largest holding is the S&P 500. That's great. You have the VEA, the Vanguard Developed Market. You have small cap. You got some corporate bonds, you have some treasury bonds, you got some real estate, you got some emerging markets. Okay, so you have a very well diversified portfolio. I think when it comes to the international exposure, I think you're actually fine. You only have 20% exposure to international. I think that's great. 2/3 of the S&P 500 generate a substantial amount of their revenue outside of the United States. So right off the bat, if you invest in the S&P 500, you're getting immediate international exposure. So really, really important that everyone understands that. S&P 500, 38%. Yeah, I think that's fine. You have a few bonds in here. I personally, so for 20 to 30 years, I would take a look at that bond exposure and maybe consider trimming the bond exposure. That's just my personal opinion. The bonds, I just, with your time horizon, you could, in my opinion, you could bring it down all the way to 5%, right? 5% bonds. You could put the rest of that into the S&P 500. And I think you would, over the longer term, you're going to get more favorable results over the long term. That's just how things are when it comes to looking at different asset classes. You're going to get higher returns over the long term in equities in most cases. Now let's take a look at your taxable account. Once again, I don't know why the chart here in M1 Finance is not working. You got 37 holdings, just over a 2% dividend yield, and a really healthy expense ratio. All right, so let's take a look. You have 12 slices in this portfolio, ETFs at 30%, tech at 15%, industrials at 12%, consumer staples at 10%, healthcare 8%, REITs, consumer discretionary, utilities. Okay, the big thing here, what I would definitely recommend is I would focus on tax efficiency. If you already know that you're going to have a Roth IRA, I would focus on tax efficiency. I would maybe I would make the taxable account, if you already know that you're going to access this portfolio in 20 or 30 years, I would focus on a lower starting yield, but higher growth. Okay. Another thing that I would do, if you know that you're going to have your Roth IRA, consider just completely wiping out the REITs in this taxable account. If you're going to leverage the money at the same time, in my opinion, there's really no mathematical sense to have REITs in this taxable account when you could have them in your Roth IRA. So that's something that you definitely want to take a look at. If you're dead set on keeping REITs in your taxable account, okay, maybe focus on more growth ones, and we'll get to that in a second. So having this 2% dividend yield, I think this is fine. I personally would try to get this at about a 1.5%. Try to get this at about a 1 to 1.5%, because then you're really going to see that massive growth, and you're not going to have that tax burden of the dividend every single year in this taxable account. So let's take a look at the first one. You got your ETFs. The ETFs you got in here are DGRO, SHD, VYM, and SPHD. Okay, I think this is fine. I like DGRO, I like SHD, I like VYM. SPHD is okay. I personally, for me, 20 or 30 years, me personally, I would rather invest into growth for 20 or 30 years, sell out of the growth, and then invest into SPHD. Over the long term, the compounding effect, you're going to get a higher return focusing on growth and then transitioning in 20 or 30 years into SPHD. So that's personally what I would do. I would look at it from that lens, from that perspective. And so that's why I personally would not invest into SPHD when I have these other really, really high quality ETFs right here. You could take a look at also one of those growth ETFs that I talked about earlier, VGT and SPYG. Let's see, look at your tech, Apple, Microsoft, and Visa. Yeah, you can't go wrong with those three. They're at about, so you got 15% here. This is, kind of going back to what we were saying with the other guy, with Josh. Let's see here. So you got 0.50 times 0.15. You're at just a 7.5% with Apple. Right? So a little bit more than I personally would be comfortable with. I try to have no one holding over 5% of my total portfolio. All right, let's take a look at your industrials. You got Waste Management, Lockheed Martin, MSM, Caterpillar, 3M. Yeah, these are really, really great. Waste Management, Lockheed Martin. I would maybe look at flipping Caterpillar and Lockheed Martin. Caterpillar is going to grow faster than Lockheed Martin based off of their growth rates. But yeah, all of these companies are great. Consumer staples, you got Pepsi, Procter & Gamble, Kimberly-Clark, Coca-Cola, Hormel Foods, and Altria Group. These are all really great companies. I personally would maybe lower consumer staples. At least for the first couple of years, I would lower consumer staples because these are your traditional blue chip, dividend stocks. I would lower consumer staples. Healthcare, you got Stryker, Johnson & Johnson, AbbVie. Yeah, no brainer. I would bump up healthcare and lower consumer staples. You're going to have a lower starting dividend yield, but that's okay because you're focused on the growth, given your time horizon. Your REITs, you got AMT, love it, Realty Income, ELS, and you got WPC. Yeah, these are really fun. This is fine. I think all of these I'm not as familiar with ELS, but the other three, American Tower, Realty Income, and WPC are great. You could look at MPW. MPW is one of my favorite buy and hold REITs out there. It's a hospital REIT, one that you could take a look at. And obviously the industrial REITs like in Stag and Prologis. Consumer discretionary, you got McDonald's and Home Depot. Okay, man. So consumer staples, consumer discretionary, flip this. You got this backwards. Consumer staples, bring that down, bring up consumer discretionary, bring up healthcare. Really just when you're looking at the total return over a longer period of time, you want to focus on the growth, and you're going to get that with the discretionary and healthcare over staples. Utilities, Nexar Energy, great. AEP and Southern Company, okay, great. Yeah, and you have this set up well. Nexar Energy is definitely the highest grower. I also like Duke Energy. Duke is really good, but Nexar Energy is probably the best growth utility out there. Materials, you got, okay, CE. Yeah, that's fine. You got financials, Toronto and Maine. Yeah, okay. I guess the only question that I would have is, like, Toronto Bank is a great dividend stock. Maine is fine. Like, I don't invest into either. I don't think they're bad, but with your time horizon, the question is just why? Why are you investing in them now? Are they going to compound and grow faster than these other companies? Are you investing into this just to get diversification into financials? Like, here's the thing with VYM, the largest one. The last time I checked, it was the largest. Don't quote me now. I'd have to check. One of the largest sectors in VYM is financials. So you're immediately getting exposure to financials. Why do you want such low exposure into financials? TD Bank is not going to be in VYM, obviously, but that's really the question that you want to ask. You only have it at 1%. It's very insignificant relative to the whole portfolio. Just understand that, right? If you're like, hey, I want to add financials just because I want exposure to financials, understand VYM has a large position or a large weighting in financials. So just as a tip. Energy, PBA, and MMP. I am not as familiar with MMP. PBA, I believe it's pipeline. Do they pay a monthly dividend? They do pay a monthly dividend. Okay, sure. Yeah, go to town. If that's what you want to do, go for it. Communications, Disney, and Verizon. Yeah, this is fine. I like that you have Disney higher. I like that you have Verizon. You could also look at Comcast, but yeah, these two are fine. Okay, so Darius, I really like your portfolio. A lot of the holdings in here, they're blue chip companies. Some of them I'm not as familiar with, so I would really, ask the question for you is make sure that you understand what these businesses do, how they generate their revenue. This is important because if you have a market correction and you see the portfolio down 40, 50%, are you going to have the conviction in these companies to hold on to them and not sell them when the market is correcting? So really, really important. And for the long term, as I mentioned, see if you can focus a little bit more on growth, right? This is a prime example, consumer staples versus discretionary. You don't want to focus on that dividend yield right away with a 20 plus time horizon. It's just, you want to focus on the growth. So I hope that this was helpful. Thank you so much for sending over your portfolio. All right, the next portfolio is from Brandon. He writes, my name is Brandon. I'm 19 years old and I reside within the Midwest region of the United States. Little background information about me. I have a software engineering internship and I also attended classes at a local community college. I used to work 2 jobs ever since my 3rd year in high school, so I have a nice savings emergency fund in my bank account. Lately, I've been trying to make my money work for me, so I've tried taking advantage of whatever high yield savings account I can to stay afloat of such high inflation right now. In addition to that, I try my best to contribute some of that earned income into my portfolio, about $100 per month. In total, I have around $2,500 in my dividend investing portfolio. Of course, I'd like to reach a point where I would receive a decent chunk of change from my portfolio to hopefully cut my hours down. I recently rebalanced my portfolio to focus more into dividend paying stocks rather than doing a hybrid growth passive income. I want to thank you in advance for your time to review my portfolio. I look forward to hearing your feedback. Well, Brandon, thank you so much, man. I really appreciate it. The strategy that you have here is really solid, right? Focusing on passive income, I think you probably have done a lot of research on YouTube. You probably have uncovered the concept of cash flow or passive income. You probably have watched a few videos on, never work again, retire off of your portfolio or passive income. There's a lot of videos like that on YouTube. I think when it comes to this, understanding your goal is going to be really important. You're at that age where you're 19. You haven't figured out the world yet. You don't know what you want to do at 19. I promise you, and I'll go so far as to use the word promise, that you're going to change your mind a dozen times over the next coming years. It's just natural. It's just how things work. Things are going to happen in your life that are outside of your control. And I think that is to be expected, and, embrace it. Understand that you're not going to have all of the answers today. What I would always recommend when you're 19 years old, focus on the things that you can control, right? Focus on keeping your expenses down. Don't go and buy a brand new car on credit. Don't get into consumer debt. Stay debt-free. Look for ways to make more money, right? You're at that age where you're 19, you're thinking about money. It's those three things that I always say: stay out of consumer debt, cut your expenses, and look for new ways to make more money. You're in a field where you could potentially make a lot of money. If you're going to go into software engineering, some of these jobs, if you have a college degree, they're making $200,000 in their first year. Let me repeat that. If you have a software engineering degree from a reputable school, you have good experience, you can expect reasonably a $150,000 to $200,000 starting salary if you're working at a software company. So the earning potential in your field is unimaginable, right? And especially with the pandemic, where companies are hiring software engineers from all over the country, right? So that's the thing that I would pursue, is seeing how you can maximize your income with your degree, because you're going to make a heck of a lot more money than, going and working multiple jobs. Like if you can get a degree and really focus on a job in software engineering, you're going to see your earning potential skyrocket. And I know what I'm talking about because I work in the technology sector, I work in sales, and it's very, very common for young software engineers to make that starting salary right out of college. So really something to definitely consider. All right, Brandon, so let's take a look at your portfolio. It doesn't look like we can see the historical performance here in M1. You have 30 holdings, you have just over a 2% dividend yield, and you have a pretty decent expense ratio. You have 30% in technology, 30 in consumer, 12 in income, 11 in real estate, 7 fintech, telecom, industrials, healthcare, and food. Now, you didn't give your time horizon, so I can't really tell you what would be the optimal weighting because I don't have your time horizon. So I'm going to assume that it's 20 years. You're 19 years old. Let's just assume that it's to reach FIRE by the age of 40. So in your technology slice, you have 30%. This is very, very similar to the other ones that we've looked at, funny enough. You got Apple, Microsoft in here. I'm going to say the same thing, I think 3 times in a row here. I just think this is overweighting to individual stocks. I personally would have IGV or another technology ETF be the largest holding and have a smaller position in Apple and Microsoft. That's how I would treat technology. Consumers, you got Target, Home Depot, and Costco. Man, your portfolio must be up a heck of a lot this year. This is a really good consumer slice for a long-term time horizon. Wow, your portfolio, look at this. Oh my gosh. Look at this, 230%. Wow, incredible. So income, you got QYLD, not a fan of QYLD with your time horizon. SEHD, JEPI, SPYD. Okay, very cool. DGRO and NUSI. Okay, so this is awesome. Now, I like all of these. All of these are fine. I like having NUSI in here. It's fine. 10%. QYLD, I would snap this. I would get this out immediately. QYLD, I shared an entire video on QYLD in the past. QYLD is great if you're looking for income today, but I don't think you're looking for income today. So in my opinion, it doesn't make a lot of sense to have QYLD in the portfolio today. You could look at adding QYLD later down the road once you look to, actually live off of the portfolio. But this is definitely a lost opportunity. You're going to get much higher long-term returns, even if you reinvest the dividend with investing into, an ETF like DGRO or SEHD. So that's my 2 cents on the income ETFs. You got real estate, you got VC, you got STAG, O, MPW, and CTRE. Yeah, these are fine. I like, your American Towers and Prologis as well. You got fintech banking, you got JP Morgan, Visa, MasterCard, and T. Rowe. These are really great. JP Morgan at the largest, yeah, okay. I personally would have Visa and MasterCard higher than JP Morgan, but I think they're all great companies. Telecom, Verizon, yeah, that's fine. This is exactly how I have mine. When it comes to telecom, you could even look at lowering telecom to maybe 3 or 2%. Let's take a look at your industrials. You got Waste Management, Honeywell, and you got 3M. Yeah, these are great. Ones that I also like for this time horizon, Caterpillar and Union Pacific are really good. I would definitely bump up industrials. I would lower telecom. I would probably lower consumer. I would 100% lower consumer because you only have 3 companies. That means you're getting 10% into these individual companies. And for me, as I mentioned, that's a little bit higher than I personally would feel comfortable with. I wouldn't have more than 5% in an individual company if you're serious about living off of your portfolio. Healthcare, you got AbbVie, you got Johnson & Johnson. Yeah, 2 really, really great healthcare companies. You could even bump up healthcare. You could lower consumer and you could bump up industrials and healthcare. You got your food, you got Hershey's, great, Kellogg, and General Mills. Really blue chip, great dividend stocks. Yeah, I think this is fine. So when it comes to this, I personally would lower your exposure to individual stocks. I would try to keep it at maybe 5, 6, 7% max when it comes to individual exposure or exposure to individual companies. And I would definitely, reconsider the QYLD. You could always add it in the future, but having it from the get-go today, even if you're reinvesting the dividend or you're investing it somewhere else, when you think about the total return, the appreciation plus the dividend, it's not the most optimal for a long-term portfolio. Thank you so much, Brandon, for sending over your portfolio. The last portfolio here is actually not really a portfolio per se, but it's more so interesting. The email that Anke here sent over, I thought was really interesting, and I felt that it would be really interesting for a lot of you following the channel. And so I wanted to share this email with everyone here watching. So Anke writes here, I'm Anke, a 53-year-old German living in Florida who quit her job in July this year and transitioned to living off investments. I've been following your channel for about 2 years and I really love it. Thank you so much for sharing your thoughts and educating your audience in such an entertaining way. Honestly, I was not sure if I was financially ready to retire early. However, my job situation was becoming increasingly frustrating, and after moving from California to Florida into a new home, I simply needed a break from the stressful 9-to-5 job. So I decided to leave my safety net and test the waters with around a $2.1 million net worth, only $1 million available for current income generation. So that means half of it is in liquid stocks, likely, and the other half is in real estate. So I wanted to share some of my experience with you. Maybe it helps you personally or gives you additional ideas for your channel. If nothing else, it helps me reflect on my decisions. First, financial awareness helps tremendously with self-confidence and having the guts to retire early or make life changes. Without the knowledge, I'd made no investments other than a savings account. I'd stayed in an unhappy situation, too scared to quit. I'd not discovered that I really liked to learn more about options trading. Okay, options, very cool. It scared the hell out of me not to get a regular paycheck, but I'm glad I jumped. I think this is so cool. The big thing here is it gives you the confidence and it gives you the options to choose what you want to do with your life. If you're in a dead-end job that is making you miserable, it gives you the confidence to take that step. So number 2 here, keep it simple. Honestly, my M1 Finance dividend portfolio is way too complicated. I created pies with sub-pies, and I'm hesitant to make adjustments due to the platform limitations and tax implications of selling, which is a great problem to have. Instead, I'm using the money from my California home sale with only two investments, SCHD and QYLD. So SCHD is the high dividend ETF from Schwab, and QYLD is a high cover call ETF that pays monthly. And so pretty significantly different, SCHD and QYLD. The income wasn't enough initially, so I did some math and sold SCHD shares in the exchange for my QYLD to make this work. The recent drop in prices helped mitigate tax implications. It'll be easy to make adjustments as needed. It is probably an illusion to think you will never sell your investments. The more stocks you have, the more adjustments you may need. I think this is really wise. When we do our planning, we think long-term that life is going to be the same today as it is in 10 years, 20 years. I think the word illusion here is really valid. I think no one knows what the future is going to hold. And so being flexible and being able to pivot in your strategy when life throws you those curveballs. Third, use buckets to budget for different purposes. I've watched you talk about having different M1 Finance accounts, but also that you consolidated to all M1, probably to maximize the borrowing capabilities. I understand. That is true. I've really consolidated on M1 for the M1 Borrow. However, I'd like to explore more investment options and find M1 Finance too limiting. For example, no way to use cover calls on your shares. That is true. In M1, you're not able to sell cover calls or cash secure puts. I find it really helps me to think about what I want to do with my money and create a different bucket per purpose with the best brokerage for that purpose. This way, I safeguard my cash flow for money for home improvement projects or more risky investments. I really like that, not having, holding all of your eggs in one basket and having a purpose, driven bucket, right? Knowing what you're going to do with the money, whether it be saving for a down payment on a house, a vacation, whatever it may be. Bucketing your investments can be a really smart idea. So my current buckets are cash flow, so selling cover calls on the Schwab ETF. You have bill pay or an emergency fund, that, and having that in maybe a high interest savings account. You have home improvement, dividend growth, and growth. So you have the M1 Finance, 1% interest, the M1 Borrow, 2%, and then you have options trading. I think options trading can be efficient. It can work very well, but I like that you have it in buckets and you're not just focused on the one. And then you have your retirement accounts, your 401k, your Roth IRA, your HSA, and then you're bucking it with retirement accounts. So again, thank you so much for helping me think more about my finances, and all the best to you and your family. Well, Anke, thank you so much for sending over this email. I think this is so great, and anyone watching this video, it's important to understand that you're not going to have all the answers from day one. And I think it's important to understand that that's okay and that that's normal. And I like how she says here, keep it simple. Not everyone wants to have a portfolio of 50 stocks. Not everyone wants to listen in on earning calls and follow up with their investments. And then third, thinking in different buckets on how you view your investments and looking at this really from a holistic viewpoint and not just thinking about it in silos. I think this is really, really powerful, and it's so great to see how different people are viewing this topic of financial independence. As I mentioned earlier at the beginning of the video, that's what it's all about. It's about buying your freedom. It's not so much about, do I have the right stocks in my portfolio for my goal? That's obviously an important component of it, but the real goal of investing is so that you can buy your freedom. Thank you so much for watching, everybody. I hope that you learned something new, and I hope everybody has a great week, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.